Hey everyone, hope you're having a great day out there. So, from today onwards, guys, call me Warren Tesla Buck. Yep, call me Warren Tesla Buck. I'm a rapper now, guys. I changed my name because Tesla has been changing my life since 2019. Tesla has been driving me insane since 2019, and Tesla has changed my life yet again today, right? Reporting crazy earnings, crazy results. Yep. So jokes aside, I hope you like my Tesla buckle. Yeah, I've been showing off a little bit. But that being said, I mean, today we're going to be discussing something very interesting, right? We'll be talking about Tesla, right? Treat it as a relaxed video, have fun with it. But it's going to be also a very mind-blowing video because we'll be talking about Tesla earnings. We'll be talking about walking down memory lane as the history, 2 years ago when I started my position, and how did they actually manage to transition themselves to be a growing monster as they are today in just 2 years, 2 to 3 years time. Yep. We'll be comparing industry peer-to-peer margins and their performance peer-to-peer. We'll be talking about Elon's huge gem drop of product roadmap. And if you're a Tesla shareholder right now, you might want to hear this. If you're not a Tesla shareholder, you probably want to hear this. Yeah. So again, guys, show a brothers from love. Smash that subscribe button if you haven't. Smash that like button if you enjoyed this video. And let's get to it. So I want to walk down memory lane, guys. Okay, I want to walk down memory lane, and I want to say that I started this position and I looked at Tesla to 2019. Okay, and for those of you that have been following us for Academy, you already know that I'm a huge Tesla bull, right? Since then. Now, why did I asked back my question? The question I asked myself is that why did I invest in Tesla back then? It's very simple. Elon Musk, right? We all know, right? There are other great channels out there talking about Tesla and whatnot, but I'll be touching into financials as a business owner as to why I think that it's insane not to be owning a piece of this business, because where they were since 2019 versus today is a huge transitional shift, right? So back in 2019, they were actually raising money. Why? Because they were running out of money. They were running out of cash. They were burning their cash. They had 10B in debt, which we'll be looking at the balance sheet later, okay, as to the recent quarter. Now they had 10B in debt, right? So they were on the verge of bankruptcy. A lot of people didn't know. They were nearly bankrupt in 2019, right? Close to 2018, 2019, they were nearly bankrupt. Yeah. So we're looking back at the revenues, right? In 2019, they were just earning 24B, but that looks good and all, but they were actually burning a lot of cash. They needed a lot of cash to expand, and that was actually a very great inflection point. Like they had to make or break that barrier since then. Yep. So in a heartbeat, Elon Musk managed to raise 2.3 billion. Yep. So how did he do that? What did he promise investors? Robotaxi. That was his bigger game plan, right? Classic Elon Musk actually telling everyone that, hey, I want you guys to visualize the bigger game plan, guys, right? Look at it, like keep your eyes on the prize. Look at the bigger game plan. We are not just a car company. We are an AI company. We are a robot on wheels, right? You guys already know this. I mean, Tesla shareholders, you guys already know this. But what did he actually promise shareholders since then? Yeah, and it's called, he called it he called it like his own ecosystem, Tesla's ecosystem of ride-sharing app, right? So think about Uber without a driver and your own car driving out to generate revenues for the user, for you. Yep. So the concept is you go to work, you park your car, you go up to work, the car drives itself to generate revenues for you. How insane of an idea is that? Now think about it. Back then, we all know that Elon Musk always manages to deliver what he promises, but the timeline is just insane because he promised 1 million robotaxis by 2020. Now, obviously, that's let's put it that way, that's BS. Why? There's so many regulatory approvals that you have to go through. Okay, regulatory approvals. There's so many, a lot of things that you need to actually fine tune and test because of safety and whatnot, right? Logically. So they didn't have that at that time, but that's why I'm so excited to be sharing this with you today, is because they have that right now. They literally have that right now, if not this year, right? It's so the future is faster than we think, and that's how qualitatively I think they're poised to be growing more. And the question I always ask myself is that, okay, are the good times, are the bad times over? Is it all upside from here, right? So we'll be sharing that later, but this is what he promised. Yep, and they raised money just like that with financing. They managed to ramp up Shanghai Gigafactory, which is another a huge inflection point in my opinion that they broke through, because Gigafactory Shanghai contributed tons of revenues, right? Tons of demand, and it helped along the way in terms of financials. So we'll be going through. Let's go through the earnings together, and I've highlighted actually some important points, and everything is important, but I've been highlighting some important points and how do I look at it in terms of a business, right? Like for the haters out there, for the value investors last time that told us that Tesla is just a car company, Tesla is not earning money, they're huge, bad balance sheet, losing money, this and that, right? But I'm telling you guys right now, if you're a value investor, you might want to hear this because it's a mixture of value and growth, right? And this is just crazy. Now, so the highlights, the cash. In total, 1.5 B increase in our cash and cash equivalents in Q4 to 17.6 B. Back then, they were just earning, 24 B in revenues. Yep. Free cash flow of 5 B or less. No, less, way less. I think 2 B. And now, in the bank, they have 17.6 B. Now, in order to ramp up with full capacity and generate probably around 500,000 to 800,000 vehicles, cars a year for gigafactories, they would have to spend probably around 4 to 6 billion. Okay, 4 to 6 billion. With 17B in the bank, they can obviously have 3 gigafactories, cash, right? So that's obviously they won't be spending in cash, but that's how crazy that's how crazy this company is right now in terms of cash, right? The ability to generate cash flows. They're in a way different transition than they were in just 3 years, right? So think about it. Why am I reminiscing the old times? Because it actually, everything that we are discussing now will actually is part and parcel of how logical and realistic our valuations should be. Yep, we'll be talking about that in a little bit. So profitability, 2.6 B GAAP operating income, leading to 14.7% operating margin. 14.7%. Okay, so I took the time to be searching another T's quarterly earnings. Yep, Toyota. Okay, Toyota. One of the renowned, obviously everyone knows Toyota. Everyone is driving Toyota, but that could be replaced in over a decade. Yep. So in the recent quarter, they have had revenues of 15B. 15B, right? Remember these numbers. 15B, operating income of 1.7B, margin or operating margin of 11.3%. So when Elon said that this is industry high, I was thinking, wait, industry high, really? Legacy companies that have been around the block for so long, right, facing chip shortages and whatnot, I'm pretty sure they're decent and mature enough to be tackling their, having more operating leverage, right? So 14% versus 11% is just insane. Okay? 3% more, and they're an EV company. Tesla's an EV company. Why do I stress EV? We all know that batteries are, the bulk of the cost, right? It's not easy for Entrons to keep coming in and just open up an EV company. It's not that simple. We got tons of costs. We got automation. We got being vertically integrated that could lower down their costs, right? We got the battery cost. So what I'm trying to say is that their operating margins right now is a breakthrough because it's more than ICE cars. It's more than the traditional way of cars, right? A car company. So should we be comparing with these guys right now? They have actually raised the bar for themselves, and they are in that blue ocean landscape. Yeah. So further down in Toyota, we got other income, which we shouldn't count it in, but their net income is at 1.5B. Yep, net income attributable to Toyota is 1.5B, leaving their net income margins to be 9.8%. Now, why is that important? We'll be going through later. Because, I mean, net income of Tesla right now is at 2.3B for that quarter. Again, more than Toyota, right? So 30.6 GAAP automotive gross margin. Operations, they have been annualized. Right now, they're having a run rate, right? Annualized vehicle production run rate of over 1.22 million cars in Q4. So why am I highlighting this? Is because we got legacy automakers having 5B, 6B cars a year, and Tesla is having a run rate of just 1.2 million, right? What does that tell us? It tells us that pricing power. It tells us their brand organic marketing, right? Their blue ocean landscape of not fighting over price, market leader, will drive up margins. They are able to sell 60K, 50 to 60K on average per car, and they can still be making money and they're still not, affecting demand, right? So this is, when I look at a business, I look at these. Tesla has the best benchmarks of a high quality growth company, in my opinion, that we should just follow and add on to criteria when we are hunting for good bargains, right? So the summary, there should no longer be any doubt about the viability and profitability of EVs, right? Tesla is helping all EV cars in a way, right? All EV companies. With our deliveries up 87% in 2021, when other companies are actually having trouble, they have at 87%. We achieved the highest quarterly operating margin among all volume OEMs. Okay, EVs can be more profitable than combustion engine vehicles. Tesla is saying F you to all the legacy car makers and saying we can be better just by fighting in the blue ocean landscape. We do not have to be below, same level as you. Yep. Additionally, we generated 5.5B of GAAP net income, 5B of free cash flow in 2021 after spending 6.5B to build out new factories and other capital expenditures. Okay, so what is their focus? Ramping production, maximizing output. FSD, which is a huge game changer, right? That's the bigger plan. Now, why did I mention, why did I walk through memory lane also is that back then, it didn't really seem possible that FSD and Robotaxi is, realistically and going to be coming in the short term. But with their update, with FSD, with billion miles of data, with the FSD progress, with beta of FSD, as Elon highlighted, at 60,000 cars right now, that is coming. The future is faster than we think, guys. Everything is going to be coming in way earlier, right? So FSD software remains one of our primary areas of focus. Over time, our software-related profit should accelerate our overall profitability. Now think about it. It's a no-brainer for Tesla cars to be, to have FSD function, right? Right now, they raised the price from 10,000 USD to 12,000, just like that. They can have the ability to raise it, and people will buy, right? So they click on it, they buy that function, and they add on to their cars, right? Because we know that Tesla cars are computers on wheels. But my point is that in additional revenue, imagine if, let's say, they can manage to secure 50% of how many cars are out there right now, or even 50% of their run rate, right, which is 600,000 cars. 12,000 times 600,000 would put us to close to contributing 15% of all their revenues. That's how crazy it is, right? And that is literally free, low cost of marketing, right? Higher margins, like they are like the AWS, where they call Amazon's operating margins per core product is actually very low, but AWS actually having 30 to 40% net income margins themselves actually brings the whole profitability up, right? So imagine having 10% net income margins at the moment on vehicles. They now can increase their margins to probably 15 to 20% over the long run. Yep. So this is a huge game changer. So we are just at the very early stages of our journey. So I'm going to show you guys like a little S-curve, scale in terms of growth cycle that we should look at for every company, right? Like think about it. The beauty of Tesla right now Well, where do you think Tesla is at this stage right now? Right? Yes, they are close to $1 trillion company. Yeah. Yes, they have only 2 gigafactories and ramping up to 4. Right? Only. Yes, they only have a run rate compared to other legacy automakers of 1.22 million. But the beauty is they are an AI company. It's software driven, right? If we were to look at the SCurve, I would say they are just here. They are not mature. They are scaling right now, but they're in the middle of growth and scale, and that they've been breaking inflection points. And that's why I think that this is a huge compounder. Like, this is huge flywheel effect in play. That's what I'm trying to say. So that's why it's crazy not to be owning, a piece of this business, right? So let's move on and let's look at the numbers. So financial summary, we have, automotive revenues at, for the quarter at 15.967B, 71% increase year over year. Okay, gross margin of 30.6. Yep, 30.6%. Total GAAP gross margin at 27.4%. Operating expenses 2.2B. Now, why is this? Is because they had to actually compensate since 2012 CEO options, which is 350B, or 350 million. Yeah. But if we take that away, looking at the core profits that this company can generate, it's at 1.9B, right? 1.8B, which is actually quite decent. Just a 40+% increase year over year, right? So why am I looking at that, right? Why am I highlighting this? Is because we want to invest in companies that have the ability to scale. We want to be investing in companies that can scale revenues higher than how much the OPEX can actually go up, right? That's the differential is the ability to scale, right? That's how they can actually expand margins. That's how they can actually scale themselves in a way to have operating leverage and actually spend lesser and lesser on operating expenses. And think about it, guys. The reason why they can actually have be having increase in margins compared to other legacy makers is that if I pull up the 10Q, the key thing is that they are only spending a percentage of revenues. They're only spending SG&A of 8% of revenues, right? The amount of SG&A expenses contributes to 8% of total revenues. We have other companies spending 20%, high growth companies spending 20%, 25, 30%. Tesla is on another level, and that's where, again, blue ocean landscape, another level of just profiting off, organic sales, right? Don't need to be investing, no endorsements on Cybertruck, right? Few million sold, few 100,000 sold, sorry. Don't even need to spend a lot of sales and marketing. Their sales and marketing contribution is just probably lumped into the SG&A, right? So if we look at the quarterly, 10Q recently, well, I mean, Q4 is not released yet. This is Q3, but you can see normally they'll have a segment for sales and marketing. It's not here. Operating expenses is just R&D, selling, general and administrative, restructuring. That's all, right? So S&M is actually lumped into SG&A, which is just 7% of total revenues. Now how insane is that, right? So this is a little bit about Tesla. Now, moving on again into the financials, we got that's how they can actually see. That's the thing. Even with 350 million in CEO compensation, since compensation, they can actually still achieve 14.7% operating margin. That's how crazy it is, right? So net income margin contributed to 2.3 GAAP, 2.3 billion, which is a 760% increase year over year. Yep. So moving forward again, for full year, they have managed to achieve total revenues of 53 billion, 53.8 billion, which is a 71% increase, right? So people are still seeking out for, growth companies, right? Having 40%, having 30%, having 35%, even having 50%. But guys, Tesla, this monster of a growth company, is having 71%. Now, my question I ask myself is, okay, before I invest in any other growth company, right? Obviously, there's more upside because of valuation. But when I look at their fundamentals, I'm thinking, and you want to be safer because Tesla has progress. Tesla has gigafactories. Tesla is ramping up. Those growth companies are in the in the world of, okay, we might have this, we are going to have this, right? It's not really there yet. So the point is, why aren't we investing in Tesla? Why shouldn't we be comparing, why shouldn't we be looking at, in a way, that Tesla is a safer, huge growth company in a way, with, very, very insane growth potential, right? So automotive revenues 47B, which is a 73% increase. Now regulatory credits are actually decreasing, which is a good sign, because it's lesser dependent on credits but more on automotive revenues, and their gross margins at 29.3%, right? So total GAAP gross margin at 25%, operating expenses at 7B. That's how they can actually have such a huge operating leverage, right? For a huge car company like Tesla right now, just spending 7B year over year is insane. They can save up a ton from marketing, right? Usually these companies earning 50B in revenues will have easily 12B in operating expenses, which is crazy, right? And obviously that grew 53%, but as long as revenue is actually scaling up more than OPEX is actually scaling, they are able to, the scalability potential will actually, surface, right? So operating margin as of the full year is 12.1%, okay, which is insane. Again, record operating margins, record revenues, record profits. Yep. So net income of 5.5B, which is a 665% increase. This itself is a huge game changer, right? So let's talk about PE. Let's talk about valuation a little bit. If we were to analyze the recent quarters, which they got 2.2B, 2.3B. If we were just to analyze this without even pegging like a huge 50% CAGR of revenues or just analyzing it, we will have Tesla to be a forward PE of 90 to 100 times. Yep. It's only a matter of time when Tesla will be a 30 PE company. But the crazy thing is, that's why I've been mentioning the SCurve, they will still have a lot of room to grow even at 30 PE, which puts them very cheap. Right now, the whole market is actually derating all these, derating values, right? Derating growth in terms of PE. But the crazy thing about Tesla is that the question I ask myself is, would I buy Tesla at 50 PE? Would I buy Tesla at 100 PE? Now, we always think about, when I invest, right? When we invest, we should think about the future rather than today. And I'm thinking about the future. I'm thinking about easily adding on 50% CAGR, they could reach to a 55 PE company, right? Forward PE. If we put all the growth metrics in and, reflect, relevant software revenues that they could have, reflecting in Cybertruck, which they have not ramped up, everything. Right, they could easily be a 55 forward PE company, and are we willing to pay that premium on this sort of company? Right, I'm talking to value investors right now, because value investors always talk about, okay, they should be a lower PE, right? Legacy automakers are 12 PE, 9 PE, 10 PE, whatever it is. But should we pay a premium for this, huge? Because this company, whether we like it or not, still there's a lot of runway for growth, right? The lower down the S-curve. Yeah, so these are crazy gems that we should be reading in between the lines when we are trying to value this company, right? So 5.5B in GAAP net income is insane itself. Now, this financial summary is that the profit level was reached while incurring stock-based compensation expenses of 2018 CEO award of 245 million in Q4. Yep, that also inclusive of they are able to reach profitability even when further per vehicle cost is added in, right? So further per vehicle cost, COGS, right, cost of goods sold, what they managed to reduce, right? What I'm trying to say is they actually managed to reduce this. That's why they can actually have profitability, and obviously they have growth in vehicle deliveries. That's why they could reach this profitability. They could improve by automotive leasing and service other businesses. there was a negative factor is that there was an increase in SG&A driven mainly by 340M payroll tax, but yet they can still achieve 14.1% operating margins, right? So obviously, rising raw material, commodity, and logistics, expedite costs, they could still manage this to have this insane operating margin. Yeah. So quarter end cash ended up with 17.6 B and free cash flow of 2.8 B, right? So we said this just now. Now think about it. With they already highlighted that within the whole year, Tesla will still continue to face rising raw material costs, supply chain disruptions, chip shortages, right? This is a company that even though 2021 they were facing these headwinds, they have managed to perform, better results, right? Record results. So this is something to think about when moving forward, especially in 2022, which they highlighted they will still continue to be facing. Yeah. So this is actually production-wise. Model 3, we can see them ramping up. Model S actually slowing down, but overall, total production is carried by Model 3 and Model Y. Yep. So I won't be going too deep into this because I just want to, touch on the numbers in terms of and vehicle capacity, right? So we saw continuation of global supply chain, transportation, labor, and other manufacturing challenges, limiting our ability to run our factories at full capacity. Yep. So, late 2021, Giga Texas, after final certification of Austin-made Model Y, we plan to start deliveries to customers. So this year, they're going to be ramping up and start delivering, where we can actually see reflection of revenues in, from Giga Texas. Yep. Obviously will be contributing to their 50% CAGR. Fremont factory achieved record production in 2021, and they foresee capacity to be beyond 600,000 per year. Yep. China, Shanghai, local production is essential for reducing the cost per vehicle. Europe finalizing the manufacturing permit from local authorities, which will allow us to start delivering German-made vehicles in Europe. Now, their market share, right, is growing, and is just below 2.5% in America. Yep, US and Canada. Now think about it. With a low market share company fighting in a blue ocean landscape, having pricing power and all those qualities that we mentioned just now, being able to profit, having a net income margin of 10% and beating industry standards of 14.7% operating margin, the whole story is already resurfaced. The growth story. Because all they need is just to be improving capacity within themselves, slowly capturing market share over the world, right? Increasing market share. And they can already have monster, 50 PE. I'm talking about valuation in terms of, financials, right? So that's the story. That's all they need to do, be ramping that up and be able to, be profitable as they are, right? Growing. And the crazy thing is, it's AI. It's backed up by AI, right? I'm not talking about their Optimus humanoid robots. I'm talking about Robotaxi is faster than we think, right? The future is faster than we think. I'm not even surprised if it rolls out this year and be contributing revenues this year. But, Elon says that he will be surprised if it doesn't is not completed by this year. Yep. So Autopilot and FSD, we successfully increased the number of FSD beta vehicles from a couple of 2,000 in Q3 to 60,000 in US today. Now we can see the vehicle delivery growth of Tesla versus other companies. You can see that Tesla has been 150% and above, and averaging probably to 50 to 60% in over since 2018. Yep. Now, battery and powertrain and manufacturing, Tesla's critical core competency, right, is manufacturing. Yep. While EVs were often deemed structurally unprofitable due to expensive batteries, Tesla again has been breaking through to tell that, hey, we are better than ICE cars now. We have manufacturing innovation, purpose-built vehicles and factories would solve cost concerns. They're trying to be leveling up, themselves to say that we are profitable, we are EVs. Newer Entrons are actually having a hard time coming in and will have a harder time to come in because Tesla has been going, all of those hurdles over a decade ago. Yep. So structural battery pack 4680 cells and many others should help us continue to minimize our product costs. thus expanding margins. Yep. So GAAP operating margin, they are highest in the industry for that quarter, which is 12%. Right? Now, when I look at volume, when I think about this as a company to invest, I think about flywheel momentum. And this is flywheel momentum at a bigger scale, right? Because they are expecting to achieve 50% average annual growth in vehicle deliveries. Elon, in the call, said that they will have a comfortable 50% CAGR. Now, how many companies out there that is already so built and so steady in a way that has 50% CAGR in growth? How many? There's not many, I can tell you. Right? So the rate of growth will depend on our equipment capacity, operational efficiency, and the capacity and stability of the supply chain. Our own factories have been running below capacity for several quarters as supply chain became the main limiting factor, which is likely to continue through 2022. Now, that is why the stock price have been selling off. Because, analysts are trying to say that, okay, they may be limiting themselves again in 2022. Supply chain will disrupt again, so let's sell the stock. Wait, that doesn't make sense. This is actually the same thing that they're going to go through in 2021. Right? So the beauty is, the underlying key that we should be taking is that it's the same in 2021. It's probably going to be worse a little bit in 2022 because of rising costs. But Tesla, they can surpass that. They surpass chip shortage issues, right? They made their own chips. They're going to be going through hurdles of solving supply chain disruptions yet again. So the question is, will there be better times from 2019, better times from 2021? Or is it going to be worse, or is it going to be better from here on in, right? So the cash, we have sufficient liquidity to fund our product roadmap, long-term capacity expansion plans, and other expenses. They are self-reliant right now. Yep. So profit to reduce the cost of manufacturing operations over time. This is what their focus is in, and they think that software-related profits will accelerate, right? Something that I mentioned just now will accelerate the profits overall, expanding the margins yet again. Yep. So I'm going to skim through the photos and charts, but I want to be going through, this is a bigger effect of flywheel, right? Ever since 2010, they've been losing money, but now it's a huge turnaround story ever since 2020. And moving forward, the only question is how, whether or not 50% is too little. Seriously, the only question to be asking ourselves is whether 50% CAGR is too little to be justifying their valuations. Because I foresee, as we know, stock prices and valuations will be pricing in things earlier. I foresee that again, the market will not discount their premium. I know now it's tough times, but market will still not be discounting their premium because they can actually see Tesla as much more than that. And if, let's say, the street appreciates, I don't care if the street doesn't appreciate, right, to be frank, because I want the prices to go lower so I can buy more. But my point is, we should be, giving this company a premium when we are, giving them valuations, right? Especially when they're already so highly profitable. Yeah. So, in conclusion, they are very lean, right? A lean-ass company, right? Having low OPEX, low CAPEX, lean, mean, money-making machine, right? Self-reliant and cash-generating by themselves, operating leverage at its best, yep. Low marketing because it's pure organic sales, right? There's no endorsements. You go to a showroom, there's no salespeople. You order everything online. All the updates are actually literally how you update your iPhone. It's crazy, right? You can see operating cash flows going up, free cash flow also going up, right? Now, obviously, Q4 performance is always the best because people, normally buy cars in the middle of the year. But this is where we see flywheel, right? This is flywheel at a bigger step. So, net income and adjusted EBITDA, all very close. It's all good, all ramping up. And that's for the quarter. This is still trailing 12 months, right? Net income and adjusted EBITDA actually going up insane levels. It's still improving. Operating cash flow and free cash flow. And that is it. We looked through that. So I want to, before I end this video, I want to be touching on the balance sheet, right? The balance sheet, which is not right now, they're in a position to be actually owning more gigafactories without having too much of financing. But reading a balance sheet, it's actually very strong knowing how much cash they have in relation to the amount of property and plant and equipment, the value of property, plant and equipment that they have. Imagine this. They have, property, plant and equipment worth 18B, but their cash in the bank is 17B. That's how of a cash cow they are, especially when total current assets is at 27B, right? Now, I highlighted accounts payable because it's quite high to be paying off within, 3 months to a year, but total current liabilities is only at 19B compared to 27B, right? And the beauty about this is they were a 10B in debt company as we saw in 2019. Now they have been ramping up obviously because they need to scale and obviously have financing. But right now they are at debt and finance leases at 5B, other long-term liabilities at 3.5. That puts them at 8.7B total long-term debt only in relation to the cash. That's how insane this company is right now. So that puts their total liabilities of 30B and their total assets at 62B, putting their debt to equity ratio at only 1 or below 1. Yep. So we touched on balance sheet, we touched on financials, we touched a little bit on valuation, we touched on why do I personally think that Tesla is an insane company not to own. I hope you enjoyed this video. Smash that subscribe and smash that like if you like this video, and I'll see you in the next one. Thank you.